Welcome to Money Manager. In the studio with me in Cape Town is Chris Freund, who is responsible for the Discovery Balanced Fund, but he is from Investec Asset Management. Briefly tell us how the relationship works, Chris.
Some years ago, Discovery decided to start this investment company, as you said, and they don't have asset management skills. So they look to tie up with an established company that indeed does have these skills, whereby we at Investec manage the bulk of the money that comes into Discovery Invest. But Discovery Invest do the marketing, and their considerable distribution reach has allowed Discovery Invest assets under management to grow from nothing 7 years ago to in the region of I think 50 billion rand today.
That's a substantial amount, and of course given the hit track record, that will continue to grow. The Balanced Fund is a multi-asset fund. You've been involved with it for how long now?
Since inception, which is just over 7 years.
Okay, how's it been going? Because a balanced fund tells me, sort of shouts conservative at me.
It's gone very well, actually. In a relative sense, it's gone very well. We've been consistently top quartile over, quite frankly, any period you choose to look at.
Yes.
And more importantly, in an absolute sense, I think has achieved our clients' objectives in that we've really achieved returns well in excess of inflation, which is the real enemy, and we've achieved equity-like returns in a balanced fund, as you say, which has less risk than a pure equity fund.
I'd love to talk to you about inflation versus deflation. You say inflation is the real enemy. Maybe in South Africa, overseas, deflation may be the real enemy. And one of your colleagues, Michael Power, is going to put out a piece on that very subject quite soon, I think. Let's get back to, because it's a multi-asset fund, tell us about the allocation. Obviously, majority equity. Give us the split.
Well, obviously, yes, but the split changes over time. On a sort of a long-term neutral look-through basis, probably around 65% equity, 35% fixed income type assets and some commodities. That varies in terms of our perceptions of where we are in the equity cycle and valuations. Right now we're looking to sort of take that down slightly. And then, as I say, within the sort of non-equity assets, we really have to make up our minds between how much to put in government bonds or fixed income, how much to put in cash, how much to put in property, and how much to put in commodities, for example.
Let's talk about equities first of all, and start with international. I usually start with the local market, but what about international? Are you up to your limit? Are you up to 25%?
We are up to 25%. I mean, I think if there was no exchange control in this country, we would have roughly 35% of our clients' money offshore on a structural basis. So given that the limit is 25%, we've got to be pretty sure that domestic assets are going to beat offshore not to have our full allocation. Because the offshore markets give you a much greater breadth of opportunity. There's many more different types of investments you can make,
yes.
Different companies and industries listed that are not listed in South Africa.
So, for example, in South Africa, you might have one particular dominant share in one sector.
Correct.
But overseas, for example, the S&P 500, you might have 20 of them.
Absolutely, absolutely. So that's a very good example. But what sometimes we have a view that yes, we'll keep the full 25% offshore exposure, but we may have a view that the currency, the rand, has weakened too much in the short term, all right? So instead of bringing money back and reducing that 25% offshore, what we'll just do in those instances is put a currency overlay, and we'll convert some of those offshore assets into rand-based assets. They'll still be invested, for example, in the S&P 500, but instead of the dollar exposure that comes up from that investment, we'll convert that dollar exposure into rands. So should the S&P 500 do well, we'll still get the sort of the offshore return. But if the rand strengthens at the same time, we won't get held back by that. But that's a rare occurrence. On balance, we keep them offshore investments in offshore currencies as well.
Staying with international, bottom up or top down, or a combination of both?
Well, it's really a combination of both. What we try and do is we look at the sort of 75% that's listed in South Africa, that's invested here. And when we consider how to invest the sort of 25% offshore, we'll look for investments offshore that complement the other 75. So the offshore investments in their own don't really have to make any sense. That's not a portfolio. That's just part of a bigger portfolio.
Yeah.
So that's the first point. And then what type of things do we look for complementary investments in that offshore portfolio? So at the moment, for example, we have not a lot of our clients' money in the Discovery Balance Funds money in American shares. We think they have run very hard.
Right.
Where we do have quite a lot of our clients' money is in European and Japanese equities, really a sort of 25% in each of the offshore equities in Japan and Europe.
Congratulations on the Japanese ones, certainly, because multi-year highs in the last couple of days.
Correct. In fact, that's a good point, just to elaborate what I was saying earlier on. So last year we had the Japanese equity exposure. It did very well, as you say. But if you just left it at that, everything you made on the Japanese market doing very well, you would have given up as the Japanese currency weakened.
Yes.
And we happened to take a view that we thought the Japanese currency was going to weaken, so we hedged out the yen exposure back into dollars, and the dollar strengthened. So we actually got a double whammy last year in terms of like the Japanese market went well and the US dollar strengthened.
Are you allowed to do that within the fund, or is that something you do externally in order to balance up the fund? I mean, it's obviously got to be within the fund, so you can do some hedging.
Absolutely. Yeah, you put a currency overlay on top of the assets, but you've got to be in charge. The South African manager has to have sight of the whole portfolio. You can't outsource 25% of it to some other asset manager offshore and then get a statement once a month and see what's in your portfolio. You have to have daily 100% sight of that portfolio in order to sort of do those things like the currency overlays.
Okay, let's go back to your South Africa now and have a look at your sector allocation, because it's a knotty issue, because there's been some activity in the last 6, 7, 8 weeks. The sectors have suddenly started to break the alignment that they've had over the last 3 or 4 years.
Correct. They have. There has been sort of the markets started to behave differently, as you say, in the last 6 weeks or so. And what was happening prior to the last 6 weeks was a fairly one-way underperformance of the resources sector. Or especially from the last 4 months of last year and the first couple of months of this year, the resources sector underperformed quite severely. So one of the reasons why we've done quite well over the last year is we had very little shares in the resources sector. But now there's a bit of turbulence, as you say, and that has been caused by, for example, a bounce in the iron ore price from the mid-40s to sort of $62 roughly today, and pushing ahead slightly of the copper price. So in the short term, the jury is out as to whether the lows have been seen in the resources sector or not.
It's a very vociferous discussion as well, and I have it every single night on television. Some people are saying it's a dead cat bounce. Other people, like myself, incidentally, which means absolutely nothing, but I'll just put my view forward, is that we have seen the low, we've had the spike back from the short covering, we've come back again, and we're not going to go up again in a big spike. But a big base formation will occur now, and maybe the risk to the downside in these commodity stocks is very, very low indeed.
I think you're not far off the mark there. I'm not quite 100% with you, but they have done so badly that you instinctively think that the risk to the downside is not that great. But we would argue the risk to the upside is not particularly good right now either. Our commodity team went to Barcelona last week in the annual commodity get-together, and came back, aside from being very bearish on iron ore, which is a pretty consensus view out there, and they reaffirmed their bearishness on that. They feel that the coal market looks particularly poor now. So some of our big companies like Anglo American, aside from having exposure to iron ore, have exposure to coal as well. And then in addition, they said the one thing that's been propping up the Anglo-American share price is diamonds, the De Beers exposure. The De Beers profits are now 60% of Anglo's profits because everything else has shrunk to nearly zero.
Yes.
And guess what's happening in the diamond market? The prices are busy going down.
Yeah.
So I'm not convinced that it's time to get back.
So although the downside may be low, and you sort of grudgingly agree with me on that side, the upside is not particularly enthusiastic either. So what you're saying is the opportunity cost of being in these commodity stocks may be too great. What sectors do you like in the next year or so, for example, short term?
I tell you, it's tricky because there's sort of increasingly large parts of the JSE sector that we don't like. And we're finding that our portfolio is becoming more and more concentrated as a result of that. Okay, so if you largely take away a large portion of the resources market, that's quite a big chunk of the SA equity market to sort of discard. Within that, by the way, we like a company, Mondi, a great deal, but it's not really a resources share, it's a packaging share. It has a little bit of sort of uncoated fine paper, more resource type of exposure. But
I was in Durban, actually, sorry to interrupt you, when the news that Mondi had just rallied 9.5%, 10% on that day. Everybody's talking about Mondi.
No, correct. First of all, they have a fantastic management team. You just have to meet them. You want to rush back to your desk and put a buy order on. They're really on top of their game. They know every machine in the world, it seems like, that's sort of getting put up by any of their competitors. Then they've spent time getting their operations in low-cost jurisdictions. So in the cost curve, if you're a commodity company, one of the things you need to do is be right on the cost curve. So when the pain comes, other people get forced out before you, and they're right at the bottom of the cost curve. Yeah. And it appears that they are quite judicious in the way they spend capital, their capex, the capital expenditure. They come to us and they say, we're going to spend 300 million rand here on this plant, and the efficiencies, what we're hoping to get out of it is X, Y, and Z. And they appear to always do that, as opposed to buying a company with distressed assets and all the problems that come with that.
Just very quickly, we've got a minute and a half left. Steinhoff and Naspers, two great, proudly Cape Townian companies, and there's so much talk about them. If I had to name two companies over the last year that I've commented upon most on radio and television, it would be Naspers and Steinhoff. Your views quickly.
Well, they've been both very kind to us. They've been gifts that keep giving to the Discovery Balanced Unit holders. So Steinhoff, as you know, is going to list later this year in Germany, in DAX, and that listing has been pushed out slightly, but still very much on track. And if you think about what's happening in Europe now, Europe it hasn't looked as this good for a long time. Now, I mean that in European terms, not in Chinese growth type or Asian growth terms, but the growth vector in Europe is really picking up. So that's good for their retail French and German operations. We still like Steinhoff a lot.
Naspers?
Naspers is the one that's just so controversial because you either love it or you hate it. Clearly it's all about Tencent, not Naspers. I've been following this company for a long time. I think Tencent management are fantastic. The big growth vector now is advertising. People have just worked out that Tencent is a lot like Facebook, and the growth coming from its advertising on your cell phone, on your computer, is going to mean that Tencent's profits grow very robustly in the future. I'm not the only person who've worked it out, unfortunately. It's a reasonably high PE.
Fortunately for you, because you got in early. We'll have to leave it there, Chris, but thanks very much for popping in this evening. That's Chris Freund, who is portfolio manager responsible for the Discovery Balance